Right, well, I think we're better to join and start. Thank you for joining us today. This is the Skadi webinar. My name's Claire Ostrich. I'm the business manager here for Skadi, and Damien Taylor is our Director of Training and Development, and he'll be talking you through today how products trade and how this trading will have been affected during lockdown. We'll have a question and answer at the end, so pop in any questions, please, if you want to along the way. And over to you, Damien. Thank you very much.
Brilliant, Claire. Thank you very much. Yes, thank you. Welcome, everyone. Thanks for joining us this afternoon. If you are here in Europe, I'm not sure if there are people coming in globally, but anyway, welcome and thank you. Yes, as Claire said, what I'm just going to go through today is a brief presentation about how products trade and how this will have been affected during lockdown, mostly from an equity and ETF background. I'll come on to sort of what my background is in a sec. Let me just click through there. But before I do, let me just talk a bit about Skadi. So we are a consultancy firm founded in 2012, focused on business integrity within the financial sector. We are made up of front office professionals, mostly traders or structurers or head of desks, who've worked sort of at the coalface of financial institutions. And we now take that sort of knowledge base and we plug it back into various different industries, mostly at the moment into the financial industry, helping out with internal investigations and also helping out compliance and internal audit. We also have had quite a lot of work recently in the working for law firms. Sorry, 1 second, something just pops up on my screen. Working for law firms on an expert witness basis, using some of the subject matter expertise that our employees have picked up over the years to help them as well. And just as a sort of introduction, today I'm going to talk about equities and ETFs and how they trade. The initial presentation that I did on this was actually to law firms, in fact, looking more at a sort of broad brush level about how they trade. So I'll skip through some of that and move more onto the end of the control function, which will be more relevant for the conversation we're having today. Just a bit of background about myself. I've worked in the city for over 24 years. I started way back when as an analyst, looking at closed-end funds and investment trusts over here in London. I then moved on to a trading desk and I've traded on both sides of the desk, as it were. I was traded as both an agency trader, so trading client orders based off salesmen's recommendations, looking to take small amounts of commission, and also traded proprietary business for some of the financial institutions I've worked for. So using the capital of the firm to attempt to make money. And having had a career in the banking industry, I then moved to the other side of the fence to work as a hedge fund manager. So I started my own hedge fund about 5 years ago, trading futures. So I have knowledge of those products as well. So over my career, I've traded mostly in equities and actually in ETFs, but also along the way have traded various other products. So traded futures, options, FX, all the way through to converts and investment trusts and other OTC listed closed-end funds. Moving on to equities. So I'll give you a quick overview of equities. We'll zoom through these slides relatively quickly so we can get through to the control stuff at the end. But as I'm sure you're all aware, they trade electronically. There's no pits left to trade, no open outcry left. They are traded on an order book, and I'll pull up an order book screen shortly so we can have a quick look at that before we move on, based on time and price priority. They are very efficiently priced, one of the most efficiently priced securities out there, because they trade so frequently, and they are so liquid. You can price these things at any point of the day, and that's useful from a valuation perspective at any given point in time. As I'm sure most of you are aware, although some might not be, they don't just trade on one exchange. Post MiFID, the MiFID rules that came out, whatever it was, a good 10 years plus ago, which opened up multiple trading venues for these things in the guise of increasing transparency, although you might argue that has not been the case. But yes, so a London stock doesn't just trade here on the London Stock Exchange, it also trades across multiple venues, including internal systematic internalizers at banks and other trading venues that have been set up throughout Europe. And I'm sure, as you're aware, the makeup of a trading floor is very different from what it was when I started. A lot of the business of trading, especially in equities, has moved to be done by computers, to be driven by algorithms. The number of traders that you would see on a trading floor compared to 20 years ago is remarkably less. There were, 50 to 100 traders on some floors back in those days, and now I think you'll find the equity trading floors will have much fewer, maybe 5 to 10 people on them. And alongside those trading mechanisms and order books, there are other systems that are used to advertise flows, so indications of interest or IOI venues that people use to post flow that they're looking to either cross up business or to advertise that they've done business in certain stocks to attempt to hook business from other clients. And moving on, here we have just a quick look at an order book. Excuse me. This was a screenshot taken probably a couple of months ago now. Actually, I'm not sure where Vodafone's trading, probably a bit higher than here, I would guess. And just here, if I move my mouse around, I'm hoping people can see that. So you can see we have the depth on the buy side of the book in a reducing price. So the maximum price people are prepared to pay on the book is currently 126.44. And as you can see, as you get to different price points, you can see the time priority orders that have come in will sit at the top of that queue. Likewise, on this side, you can see the offers in the market and when a trade occurs, when someone crosses that book. So at the moment, the book sits 126.44 to 50. And if people are happy to wait and buy, they could sit on the bid at 126.46, or they could lift that offer at 126.50. Also on this screen, you can see the time and sales of the recent trades that are going through. And also, more importantly, if you look down here, the volume distribution, which is what I was talking about earlier, that explosion that we've seen in different venues for reporting purposes and for trading purposes. You can see about a third of the volume so far has gone through in the London Stock Exchange on this day, whenever it was. Can't see the date actually. And on top of that, then you see the volumes that have gone through on other exchanges. So a good chunk of that has gone through there on the XV exchange, and then 10% through on Chi-X, and 14% there on Turquoise. So just looking at the mechanics of equity trading, more how an order, once it is generated by an external client, then moves through the external client through into the bank, and then how it's distributed within the bank. So if we take the order book we saw before, which was for Vodafone, let's say a client comes through with an order to buy 10 million Vodafone, that would be given from the portfolio manager through to his dealer, which would then that would be communicated. Quite a lot of this could have happened all electronically, from a dealer through to a sales trader, or quite often just direct to a trader. And then a trader has 4 different outlets, I suppose you'd call it, for where that trade can go. So he will either go on risk, he might be able to go on risk, or at some certain institutions might not be able to go on risk. Pure agency brokers, some of which I've worked at, you can't put up risk. You were literally looking to work that order in the market, in which case you would be looking to use either algorithms, or you would just look to work that order yourself. So the trader has a decision to make. If he can go on risk, he might look to kick the order off in a certain size, 1 million shares, maybe to hook the 9 million extra, or he might be able to possibly go up on whole risk for the entire size of that, or he might have internal order flow that he's able to cross up against that. I mean, in a perfect world, the trader would look to deal with other clients. If you could cross up that business, it's the most efficient trade really for the bank, as it can take commission on both sides and then sits risklessly in the middle. But the trader also has the outlet of being able to use interdealer brokers, or IDBs, who are constantly providing flow from other financial institutions through to them. And maybe you might find that there's a match against an IDB to be able to execute that trade. And what I'll now do is just go quickly into ETFs, which are very similar to equities, certainly in the way they trade. They have just a few wrinkles underneath them that I'm sure you're aware of, but it'd be useful to go through as well. So as I said, they trade the same, but the mechanics are different. They've been a huge success story over the last 20 years. I think the assets now, and this was done a few months ago, is probably even larger now, given the move we've seen in the markets. But certainly earlier this year, the assets had crossed the $7 trillion mark, $7 trillion mark in ETFs. They differ from other types of funds, and they're a sort of hybrid, really, I suppose, of open-ended and closed-end funds. So a closed-end fund structure, obviously, when you raise your money, the price of the fund is actually derived by the market. So the price and the NAV can diverge, and quite often do. Quite often, closed-end funds trade at discounts. But the advantage of closed-end fund is once you've raised the money, that capital you have then to invest as you see fit, and you are not being concerned with redemptions or subscriptions that you might see, unlike an open-ended fund, which has to, as it sees these subscriptions and redemptions come through, has to trade the underlying securities to balance that in the market. So what the ETF does is a sort of structure, is a sort of hybrid of the two. So it trades on a minute-by-minute basis on exchange, and at the end of every day, the authorized participants, who I'll come on to, and the market makers, have, via something that's called the creation and redemption mechanism, they have the power to create and redeem the units for the underlying securities that ETF tracks. So that acts as a balancing mechanism whereby the NAV and the price of the ETF tend not to diverge, although in fact, during the sell-off that we saw and then subsequent very large rally that we saw at the beginning of this year as lockdown hit, some of those ETFs did move out to discounts, not particularly wide discounts, but actually they came through the increased volatility that we saw then with sort of flying colors. Really, I think there were questions about whether ETFs would be able to cope with that volatility, and they seem to do so. And what an ETF does is it allows hedging of underlying securities and also a broadening of mandates. So because ETFs themselves can invest in a multiple array of products, from commodities through to baskets of stocks, they can allow fund managers access who may only have access to be able to trade equities, to be able to trade underlying products that they wouldn't automatically be able to. And just at the end there, just to have a quick talk about physical versus synthetic ETFs. The bulk of ETFs out there, I think, tend to be physically backed, as in if you buy a share in the SPY ETF, the S&P tracking ETF, actually underneath that are the physical securities that the asset manager will own, whereas a synthetic ETF will tend to track its NAV more closely, but it is written on a synthetic product. So there is a counterparty risk within that ETF, depending on which asset manager has written the ETF. Just going on to the mechanics of ETF trading, they trade, as we've said, in a very similar way to equities. However, especially in Europe, liquidity on the book can be slightly misleading, and this is an issue that I know that the ETF participants in Europe are looking at. Certainly compares to the US, where liquidity is much deeper on the book itself. A lot of transactions in ETFs tend to go across the market, against market makers, and be printed on other exchanges rather than main exchange. So if you looked at certain ETFs, you might only see that a few hundred or few thousand shares are traded. There might only be a few hundred or thousand shares bid or offered. But in fact, if you speak to some of the market makers, including the banks, obviously outside of the banks, there are specialist market makers in these things, such as I've listed here: Optiva, Jane Street, Flow, Susquehanna, and they will make you a price in possibly very large size, because the liquidity of the ETF is really determined not by the liquidity that you can see on screen, but by the liquidity of the underlying. So, for instance, an ETF that is trading gold or oil, big liquid futures, if you looked at the future, you might be able to trade $10–20 million of that thing very quickly in a few trades. So, and that liquidity on the underlying can be reflected through to the ETF itself. So even though it might look like there isn't very much liquidity in a specific stock, these market makers will be able to make you prices in much larger size than you can see on the book. And quite often, a lot of the large banks will offer screens through to clients, to end clients, that would allow them to price decent size in these things very rapidly. So you might literally use something called an RFQ, a request for quote screen, that you could literally type in, I want to buy $10 million worth of this specific ETF, click a few buttons, and they'll make you a price very close to where the price is on screen, even though there might only be a few thousand shares up there at the time. And I'll just go through a couple of examples of why ETFs can be, well, good and slightly and bad as well, I suppose you'd say. This is just an example I've seen a few clients of mine over the years use as a way to use ETFs to build synthetic positions in underlying securities, because of the nature of the ETF and the fact that it's tracking a basket of in this case I've written up here of 10 stocks. You could actually build a position in those stocks, in one of those stocks, by buying the ETF and then shorting the 9 other constituents against it, which would give you a synthetic position in that stock. So as I put here, in these 10 equally weighted constituents, if we're looking to buy position D, you could actually buy the ETF, short the other 9 against it, and then the structure that you created would therefore track the price of D. And in fact, if at any one point in time you wanted to take delivery of that security, you could do so by using the market makers or authorized participants to swap the ETF for the underlying securities and take delivery of that share. So that's a way that I've seen people use to start to build positions without leaking their intentions through to the market. So it's a quiet way to start to build a position without leaving any much of a footprint in the underlying security that you're looking to trade. And another issue of ETFs, and I sort of touched on this before, is the divergence from the benchmark, and this can be an issue and was an issue in that sell-off that we saw earlier this year. So here's a USO, which is a US listed ETF that tracks the oil price. And obviously, as people remember, when oil fell out of bed and actually went negative in the near month, that caused big problems for that ETF. And people might argue that the ETF itself was responsible for some of those issues, as it had such a great position in that near month that had to be rolled through to the next month. But what you've seen here, if you look at this chart, is how that sell-off has then created a big divergence in the ETF itself and then the underlying that it's supposed to be tracking. So as you can see, they've tracked each other very well from the start of the year down into that sell-off. And then as there's been a rebound in oil, USO has not participated in that. So that, you know, if that is your mandate to track oil and you're unable to do it through the future and you've tried to do it through this ETF, then you have to realize that there's a chance that you can take a big divergence from that underlying security that you're trying to trade. Sorry, moving back, but we'll now move on to sort of the internal control side of this presentation. So these are just some of the issues to think about in normal markets, and then we'll go on in a couple of slides to look at what the working from home environment, what that move at the beginning of this year, as the virus struck, to cause people to move from home, could have caused issues on the control side of things. So I'll just click through these so we can look at them as a list. So in normal markets, what people are concerned about, what are people thinking about? Well, at the top of the pyramid really is best execution. So all clients have to be given best execution. A lot of the systems and trading systems are built around making sure that this happens, so that when client orders come in, they're time stamped, etc., and then they move through the market. Then there's ways to measure how those are transacted against other orders that have gone through in the market, etc. So best execution, absolutely key. And in keeping with that, communication and audit trails of those orders as they come through is absolutely key. So we'll think about, you know, how these things would have been affected during lockdown. But if we carry on here, we can look at sort of information leakage. And going back to the chart I was showing about how an order came through from the client through to the bank, at each point in that communication trail, there is a danger of information leakage. I think under normal markets, a lot of those a lot of that information travels electronically from client to bank down secure lines. All those lines are internal to the bank, but obviously there are issues if people have suddenly had to go and work from home. So we can look at that later on. There can be issues with algorithms, and I've certainly seen this in the past. Most famously, Knight Capital had issues with algorithms when looking to execute trades. I think the algorithm was supposed to be running large orders over over many days, and in fact was programmed incorrectly to trade over over half an hour. And in fact, that movement in that algorithm was enough to put Knight Capital out of business at the time. We also need to think about front running, market abuse, also conflicts of interest and restricted lists, and also, actually, as I wrote in there, corporate actions departments keeping files up to date. And finally, looking more down at ETFs, we're looking there could be issues about deviations from a benchmark, a bit like that chart I was showing you of the USO, and also looking at transaction cost analysis, so TCA versus an illiquid tape, because ETFs can trade so illiquidly on market, and then a big print goes up off market that is a market maker making a price. You've got to think about how you measure how efficient that transaction was versus the trades that would have occurred on that illiquid tape. Moving now to look at what's happened during lockdown. First of all, I'm just going to have a quick look at the issue of recorded lines. So there's been, at the time as lockdown hit, a fair few controls were relaxed just to try and keep businesses going, keep business continuity going. Certainly since then, we've seen, this was a couple of months ago, slightly different messages coming through from the FCA and from the CFTC. The FCA have basically said, all lines are expected to be recorded as exactly as conditions were before this all hit. The FCA has warned banks they must now provide the same standard of surveillance that they were before, and that firms now have overcome these challenges as we move into this sort of new normal. CFTC have been a bit more relaxed. They've certainly extended the relief on recordings through to January, but the expectation is that from that point of time, they would also look for recordings, etc., to be done exactly the same way. And finally, just moving on here to things to think about from a control perspective. As we've moved from that very controlled environment of working within a bank to the external working from home environment. So I'll click through these and then we'll just go through them. So big things to think about from a control perspective. Were there breaks in the trade capture and record keeping? E.g. were there issues on recorded lines? Obviously, it was a sort of double whammy. People were forced to go and work from home, plus there was a massive uptick in volatility as markets reacted to what was going on. So the issue will be looking back over that period of time, and much of what control functions do is all about that, is being able to go back and reconstruct what happened if there has been an issue. So were there breaks in that? Could that cause issues for people going forward? Were usual, for instance, trade error reporting procedures kept in place, or was all this in the sort of mad scramble to get home and get everything sorted? Could there have been issues around that? Certainly, as lockdown hit, about a month after lockdown had hit, we took the decision to speak to some of our ex-colleagues to see how they were coping and what was going on from their perspective. And most people said, in fact, that that it had been a relatively seamless transition actually to working from home. Most people had recorded lines up and running, sometimes immediately, because they had voice over IP phones in place anyway. Most people said that they were surprised actually that how resilient it was, that a lot of the issues that they thought might come up were okay. And certainly it's a great testament to how far telecommunications have come in the last few years. I think if this had happened 10, 15 years ago, we could have been in trouble. There would have been real issues around these sort of things. But yes, there's certainly concerns around moving people from those internal bank secure networks to home broadband. I mean, there's issues possibly around hacking. There's issues around security about home broadband, basic passwords, etc. So that needs to be looked at and addressed. Another thing to think about in that mad panic, that initial scramble, were reporting lines changed internally? Were compliance people or were compliance reporting lines changed, etc. And also, as people move to work from home, there'd be massive increased opportunities for insider dealing, large increased chance for information leakage. The great thing about the investment bank is that all that information stays on site, and then suddenly when you're getting people working from home, the chance of some information leakage certainly starts to go through the roof. Also, there would be issues around policing of conflicts of interest. And finally, as almost most importantly, that leaking of all that internal sensitive information. If there are flatmates working, in a flat share, one working at one bank and one working at another, you need to be very careful that the information does not leak across to the other people there. And that is the end of the presentation. Thank you very much for your time. I think we're going to do some Q&A, and also, Claire, we're going to try and put up a poll, although this is the first time we've done this. I'm not sure if this is going to work. But
thank you very much, Damien. Yeah, no, very, very interesting. We've got several questions. It's gone a bit dark since you started, so I've had to put my lights on. But anyway, yes, we've got a little poll. While I'm organising the questions, we've got a poll that maybe you'd like to just do.
Oh, yeah, there you go.
I don't know if you can see that, Damien.
I can see it. It says I can't vote on it. So.
All right. So as an auditor, how have you found review and control during lockdown? So I'm just going to get the questions up while you have a little go at that. Oh, that's good. Excellent. Okay. A couple more answers just coming in. Oh gosh. Get your votes in now. It was 50-50 a minute ago. So.
Oh, blimey. Have any questions coming, Claire, out of interest?
Yeah, I've got quite a few questions. So
okay, cool.
A couple more seconds for the poll, and then because there's still some people voting. Very good. Okay. All right. Okay. Right. So the answers was obviously.
Do you know? I think you might be able to show the results. I don't know how you do that, Claire.
The options. No.
Or you can just tell, I suppose.
Yeah. Sorry, it's not showing me on there. It's well, obviously as an auditor, how have you found review and control during the lockdown? There was 3 possible answers. The same as before was 46%, which is good. More difficult, 52%, and easier, 2%. So
there you go.
Some people really enjoyed it. So that's the poll. So okay. Oh, I can share results. I've just seen it.
Oh, there you go. We can see that now.
There you go. Okay. Right. Thank you very much.
As you probably expect. I mean, you'd think that, as teams have been split and people have had to move to work from home, to get people together to be able to do review and control must be a lot harder. In a way, I'm surprised that you're probably not seeing the more difficult higher up. But anyway, thank you very much, everybody, for voting on that.
Yeah, very good. Right, so yes, several questions. Okay, to what extent does the use of algorithms mitigate some of the risks of staff trading remotely?
Yeah, I mean, I think that's it would have been a big help, certainly, because as you get busier and busier as a trader, the one thing you can lean back on is the fact that you can run multiple orders more quickly if you've got algorithms there to help you. So yes, provided your systems are working and you can log in through to the bank internal systems and get a hold of those algorithms to be able to trade, yes, I think that would have been a help, would have been a mitigation that would have helped traders, most definitely.
Okay. And do you think ETFs have increased the volatility in the markets?
Um, yeah, yes, I think there's probably an argument that they might have done. I mean, as volatility really went up, you did start to see some of the prices diverge from NAVs, which would tell you that they are starting possibly to have an effect on the underlying liquidity of some of the shares. So, you know, if everyone's rushing to the exit at the same time, then yes, that can definitely have an influence on the price, and you might see a divergence of the price from the underlying. But certainly the bond ETFs, which is the area that people thought could be most affected, held up incredibly well. And in fact, a lot of ETF issuers would argue that the ETFs themselves provided a more accurate pricing mechanism for the bonds, whereas, you know, if you'd been forced to sell that portfolio of bonds into the sell-off, you know, you could have had trouble. You could have exacerbated the problem. So the fact that the ETFs kept trading and pricing and balancing buyers and sellers may well have helped increase, or yes, not increase, I suppose, just help slightly smooth out some of the volatility that we were seeing.
Okay. All right. Are ETF orders large enough to be market moving? Could it be possible to profit from ETF flow trading in selected underlying shares?
Yeah, good question. I think they can be, yes. I think if people are, I mean, you've got to remember that not all ETFs are tracking shares themselves, but yes, if you look to what happened in USO, for example, a lot of the flow, a lot of the issues around that negative price, that price going negative in the near month were caused by, I think, people looking to front run the trade because they knew that USO were a big owner of that front run. They knew they had to roll those positions into the next month. So there were some shenanigans going on there where I think people were looking to sort of force their hand. They knew that there was a big sell order coming in one and a big buy order coming in another. So that spread between the 2 months on the roll was really pushed out to wide extremes. You know, the market making, a lot of the market making ETFs goes on by you know, agency type houses. So, you know, if they see a very big order in an ETF, they will try to limit the, you know, they know that they can price to a certain size and they wouldn't price above that size because I'm sure that they would be aware that there'd be a market impact. So as they then look to unwind that trade, you know, they want to make sure that they're not going to be left on the hook and take a big loss. So yes, I think people are aware of what goes in some on in some ETFs, and I think retail might look now and again to try and trade some of that. I think, you know, the arbitrage opportunities that get thrown up tend to get closed though pretty quickly. So yes, an extremely large order in an ETF could cause issues, but it would cause issues in the ETF and possibly in the underlying as well. But yeah, no, that's a good question.
I mean, I'm learning about this. Is that front running, or could that do front running?
If someone leaks the order, then yes, it would be. But if once the order has printed in the ETF in the market, then people know that order has gone on. Now,
Yeah.
If the print goes up towards the offer side or slightly wider than the offer of where the price is, then you've got to expect that the client underlying was a buyer. So then people might look to trade against that, but that's not really front running per se, because there's the information itself is now out in the public domain that the print has gone up. But you know, a lot of, I mean, there's certain size, over a certain size in ETFs, you can elect to delay the print to attempt to allow you to unwind that trade before the main order hits, and then you can see that, you know, that there could be an issue in that name.
Okay. That might follow on for this. And what are the possible reasons the price of ETF diverts from its constituents?
Well, the real issue there is the liquidity. So if everybody is because the price is determined literally by buyers and sellers meeting, if there are more buyers and sellers, they can keep chasing up that price away from the NAV. Now, the great thing about the ETF market theoretically is that if that becomes too extreme, there's an arbitrage there. So market makers and authorized participants can short the ETF itself and then look to buy the underlying securities because they'll be at a premium, and then look to close that gap when they at the end of the day can create or redeem the units in it. So you could trade it during the day, and then at the end of the day swap the two through at zero or very close to zero. So it has a balancing mechanism within it, so which should theoretically should equalize over time. But there can be dislocations in extremely fast markets, but provided the ETF doesn't go under, which has happened in some of these sort of triple leveraged ETFs, which are dealing in strange derivatives, giving you sort of 3 times leverage to the negative move in oil. Over time that will build, the arbitrage will exist for a while and then be arbed out, because it's just, that inefficiency won't carry on in the market.
More questions. Sorry, Damien, your expertise here. To what degree do you suspect algorithms with different interpretations of market signals drive volume or volatility?
I mean, a lot of the bulk of algorithms people use tend to be time sliced algorithms or VWAP algorithms. So they will be based on historical patterns and historical data patterns, which, for instance, you tend to see, certainly in Europe, the bulk of the volumes will tend to be pushed towards the end of the day, for example. So an algorithm will tend to try to track that. So I can't remember the exact. Sorry, can you repeat the exact question?
Sure. To what degree do you suspect algorithms with differing interpretations of market signals drive volume or volatility?
I don't know really. It's hard to tell. I think a lot of the algorithms will tend towards themselves. So, but yes, if they are all looking to buy stuff towards the end of the day, they will keep leaping ahead of each other. So they could increase volatility by pushing up a price when it doesn't need to be, just because every algorithm is trying to do the same thing at the same time. But what would tend to happen is that after a while, that price would be pushed so far that people would come in and look to trade against that to try and equalize against that. So the market so non-algorithm participants will tend to see that something maybe is getting out of whack and then look to trade against that to try to equalize it.
You're not off the hook yet. There's even more. It's obviously a hot topic. Why didn't the oil ETF and the underlying converge?
Well, the underlying went negative. I don't, at the moment, as far as I'm aware, you can't get a negative price in an equity, but the underlying of that went negative. And now I don't know if you mean at the time of that sell-off, or if you mean the rebound we've seen since then. So at the time of the sell-off, USO collapsed, but I'm not sure, it certainly didn't go negative. On the rebound, I think what's happened is, because USO had all that problem at the time, it's actually had to change its mandate. So it's not just investing in the near month or the near 2 months, it's investing further out. And in fact, I think it's not just investing in West Texas, it's now looking at Brent crude as well as a diversifier. So the problem has been that, in fact, if you read its exact mandate, it's looking to replicate the daily move in oil. So the problem is, it's not really a particularly useful instrument to trade long term, to attempt to collect the exact or replicate the exact movement in oil itself. What it's doing, and you could trade it intraday, fine. If you bought it at the open and sold it at the close and oil was up 2%, then the ETF will probably be up 2%. But over any period of time, because the ETF is constantly having to pay to roll contracts, et cetera, you'd expect it would slowly start to diverge. And unfortunately, what we saw earlier this year was that extreme move to the downside meant that the model was slightly broken. So you're not really tracking. You might be tracking now that the sort of that mess has all been cleared. But I'd certainly, not that we're looking to give investment advice here, but I think if you're really looking to track the oil price, it's not really a particularly useful ETF to use because of the underlying nature of futures, etc.
Right, I've got a biggie for you now, so pay attention. will eventually ETFs with large balances with more liquidity win over market share from other similar ETFs? In that case, should there be a mechanism to protect interest of investors in smaller ETFs? The market makers outside of exchange can help to an extent, but is there a guaranteed solution in such case?
Blimey. Well, actually, I can see this question now, so I need to read through it again, really. I mean, yes, I mean, as you've seen, the vanguards of this world who are creating ETFs with incredibly low fees, they tend to be hoovering up a lot of volume and a lot of passive volume, which I think you could argue is causing problems in the market, because if you're an S&P tracking ETF and the S&P has kind of really only been driven by 5 stocks in this rally, all these huge FANG tech stocks, ETFs could be, the slight problem to do with that, because they're passive investors. I mean, they are just forced every day at the end of the day, if they have another $10 million of inflows, they blindly have to close their eyes and buy to replicate what's going on in the S&P. So they can sort of they're exacerbating, I think, the problem almost on the way out, which is the big stocks are getting bigger and the smaller stocks are sort of staying where they are, getting smaller, certainly in relation to the index itself. So I'm just reading through the rest of this question. Should there be a mechanism to protect interest of investors? Well, there probably ought to be a mechanism to protect the interest of investors, but I would, at the end of the day, the cheapest solution will win. So I mean, investors will theoretically keep pushing money into the cheapest trackers that are out there. Smaller ETFs, I think the ETF market, like any market, if you're a small ETF and you're not really gaining traction, slowly your balances will dwindle and you'll just be arbed out of existence, and the money will continue to flow to the larger ones. There was a third part of that question as well. What is it? Market makers outside of exchange can have an extent, but there's a guaranteed solution in such case. I mean, that's a great question. I'd like to think that the smaller ETFs that might be maybe doing something a bit more interesting and esoteric will survive, but it's hard to see, really. It's hard to see that just the money talks, and if the money is always flowing into those big boys, it's hard to see how the smaller ones keep going, even though maybe there is a definite rationale for them to be there.
There's another one. Thank you for that. That was a biggie, wasn't it? This is a nice one. Is there a central counterparty for ETF market?
So I think it's a good question. I don't know is my honest answer. I don't think there is. Not the way, for instance, that there's a central counterparty in futures. If you're trading in ETFs, at the end of the day, the authorized participants are making markets and then can create and redeem with the fund manager or the ETF manager. But I'm not sure that there's an actual central counterparty per se.
Okay, I think I've got another one. I don't think I can ask that question. What was the biggest bonus you ever got?
Oh,
I think that might be.
I think the biggest, well, it wasn't actually that big, and it was way back when, very early on in my career, in fact. Oh, I can see exactly who that's from.
Yes, I don't think you need to answer that. Thank you anyway.
Not big enough, apparently.
Right, well, that was great. Thank you very much. You had lots of questions there. We are recording this and we'll be sending the link to Mercher, then you can share it with everybody. But Damien, thank you very much. Thank you for everyone for joining us. And thank you for your great questions. Really had to get your stinking hat on for that. So thanks very much. And good night. Thank you.
Cheers. Thank you, everyone. Bye.